Good morning, everyone.
Good morning.
Morning.
Good morning.
Hi, Martin. Hello, Brit, Edwin,
Hi. Hello.
Hello.
Thomas, Jura, Robert. Nice meeting you again, and welcome for this Transeo Academy session about search funds. I will now leave the floor directly to Laura, and then she will introduce our speakers, and we will let them speak. So enjoy this session. It's recorded, so we'll send a replay and the follow-up emailing as usual. So enjoy. Just a reminder for those who are not registered yet for the Transeo Summit, don't forget. And we're participants, so it's great. But if you are interested, it's still time. So enjoy this Transeo Academy, and I leave the floor to Laura.
Thank you, Marie. So today we will have an academy on search funds. It will be presented by Carl Pitchford from Espace Estis. He has already presented a lot of Transeo academies, and it's always very interesting. So I hope you will enjoy this one. And today he will be joined by Paulo Ribeirinho from Novastone Capital Advisors and Mikko Järvinen from True North Search. So they will give testimonies at the end of the session. There will be no breakout rooms today, but there will be time for Q&A at the end of the session. And don't hesitate to ask any questions in the chat or in the Q&A session, tab of the Teams application, and we will answer them by the end of the session. So, Carl, the floor is yours for your presentation.
Thank you, Laura. Let's get rid of people down the end there. So there we are. Welcome, everyone. So the idea, first of all, is that I give a short overview about search funds. So there you've got a little bit more information about me and my membership. So I'm a little bit different because I'm a practitioner, and I've been for a number of years in business transfers, mainly to employee ownership, but I've been working over the last 5 years as well, more directly and individually with search funders. And as you can see, I'm also head of programs at the two schools that you can see behind my head, which are based in Lille in France. So I think it's important to understand and to have a few definitions, first of all, because I think some of you will already be familiar maybe with the term search fund. It usually stays in English, and we try to translate it, but we come out with some complicated things in different languages. The origins go back quite a while, so it's not a new phenomenon. We're going back to Stanford University in the 80s, where the idea was to persuade young graduates, mainly with MBA, to go out and look for a company to acquire rather than start their own company. I think that's still a valid principle today. How far we can go with younger students and how much experience we could actually need to run a small and medium-sized firm, or maybe something a little bit bigger, will obviously depend on each individual, on our experience, the size of the company, probably the area of the country, the culture. So a lot of elements in there. But it's an interesting phenomena, and just speaking with a few participants, it is growing in Europe. There's a lot of talk around that and who's involved in it and how we're going. We could say that it offers a quick, low-risk path maybe to business ownership. It's the idea of bringing in a new generation, I suppose, of CEOs of all of these small and medium-sized companies that are going to be coming on the market, a lot in Europe, but a lot globally as well, as you know, as we all know that the baby boomers are going to retire shortly. I've actually focused on taking over a company that's in good health, and the idea behind it somewhere is that private equity. So we've got specialized private equity firms that actually obviously acquire the business with the future entrepreneur, future CEO. So I've tried to split it down in phases because obviously in an hour, we can give a lot of information. And of course, if any of you want some extra info on any part, please feel free to reach out to me later on. So there's the search phase funding. So here you can see we're talking about a reasonable amount. We could go up into the lower millions. I've seen a couple of deals already, 1 or 2 million, but that's usually the amount that we get from investors, which could again be private equity, could be some sort of venture capital, could be some sort of hybrid investor team. And the idea is that the amount is to search for the company, and it could be cut up to 2 years. I've not seen anything longer. This will enable the searcher to cover expenses, salaries, travel, carry out due diligence on a number of targets, and maybe even cover the expenses of an intern somewhere to help them in this search phase funding size. Okay, now searching for a business. As we all know, everybody's looking for profitable, stable businesses. So I've given you, it's quite a broad range of companies, somewhere between the 5 and the 50 million. In my experience, I've probably seen one for the moment, which was more or less, let's say around about 70 million, but that's still very, very rare. We're obviously looking for companies that have positive EBIT, so 1 to 5 million as well. Preferred targets, owner-operated business. So again, when I look at that and I look at the members of Transeo, and I've had the opportunity to talk with quite a number of you during different sessions and summits, that's really the target that pretty much we're all focusing on. Owner operators, no succession, looking to retirement. Could be other reasons, could be, maybe health or something like that, maybe a change, what we call in between brackets lifestyle change, but usually let's say a company that's really in a positive situation. Okay, so then there's the acquiring of the capital. So again, meeting with investors, closing the capital raise and the different rounds. So obviously, then we know that when we go and look at a target, the money is there. Most of the deals and the searchers I've worked with have put in their own money alongside investors. So I think that's also an important element, that if you are going to work with searchers, and I'm sure that Mikko and Paulo are going to touch on that topic a little bit later. So it shows really that you've got skin in the game, and that you've got a certain amount, which could depend on various things that you've done in your past professional life or whatever. I've worked a lot with various families where sons and daughters may have received a certain amount to get them out of the business for whatever reason. And obviously they say, well, go away, start your own business, buy another business. And so the amounts could be, quite sizable, let's say. So the idea is that the searcher actually operates the business and of course exits in a given timeline. I'll show you some diagrams a little bit later. So the idea is usually that they don't hold the company, is they keep it for a period which can resemble the periods that private equity works on. So I've seen around about 7-8 years. And of course, that enables everybody to recuperate some sort of return and dividends. And it could enable the searcher then to go on, look for the next opportunity. maybe even depending on the size and how the business has grown, could even, you know, buy out that company and carry on with it if they so wish. So you know, it's pretty much open door in terms of exit. So we could sell it on to somebody else. We could go for an IPO, whatever. So here you've got a little bit of a diagram which summarizes that part. So we're looking the search capital up to 2 years, okay, and then actually operating the company up to the exit. We could say anywhere between 5 to 7 years. Okay, and over that period, obviously, we're repaying the debt a little bit like, you know, a standard private equity venture capitalist, etc. So I think that diagram also gives you a rough idea of how the system works, and then you can go here, because a lot of people also talk about entrepreneurship through acquisition, entrepreneur owners, entrepreneur ownership. Okay, so you know, there's a lot of terminology out there. Basically, we're always coming back to the same sort of system. Obviously, in terms of the person that we could be, you know, the potential future owner, future CEO. This could be a first timer, and we could go as far as somebody with proven management experience. So I'm currently working with somebody who has more or less 15 years management experience in different areas of industry and in different countries. Okay, it's a model that I'm talking to my students about. So I'm actually running a class on entrepreneurship through acquisition, getting to think about the future, the opportunities. We have students who are in incubators with their own company, and it's something that I would like them to consider. Maybe not after they graduate with a master's, but maybe, you know, in the future. I said, well, you know, maybe if you can get yourself in a job in a family firm, in a small firm, and you work your way up, that could be a possibility for you afterwards to, you know, get shares in that business and ultimately, you know, why not acquire it, or at least become a minority shareholder, you know, in the beginning. So this is the classic here with minimum capital. So we're starting, you know, and we're going from 0 up to 100. So this is the main search fund. So promising managers with experience. The original model looked with MBA students, and of course then in Spain there's been a lot of work with IESE Business School, which has developed that quite a lot. They've got their own conference as well on search fund for search funders. There's also a growing number of investors, again in Spain, in the UK, in France, that are also focusing their business model on working with search funders. Okay, so here you can see where we are in the middle here, and the owner operator. Okay, so we're moving into the later stage professionals, and as you can imagine, the more experience we've got, the more capital actually the search, then that's going to open also doors for more access to capital to be able to acquire that business in the end. Okay, where can we link that in? And as I said at the beginning, you know, some of you may be familiar with this, you've heard about it, and hopefully with what I've explained so far, you can understand how the model works. Again, you know, what's could be in it for you. It's another opportunity, I think, to get out there and, you know, be present. I've put at the end of my presentation as well, for those of you who'd like to go further, a couple of websites where you can see conversations with searchers globally, what they're looking for. You can become a member of those different websites. You can sign up, and it will give you access to searches, also profiles of, you know, targets that they're looking for. There's questions about valuations, there's questions about capital. Okay. And I just think that it's, adding an extra part somewhere to your current activity, because you're working with small and medium-sized companies for the most of us. We're working with current owners who would like to, pass on, find a succession route. We spoke about that in earlier academies. And I think it's, some way where you can add value-added services and obviously also, tailor maybe some sort of strategy to work with them. So it's important to understand the dynamics behind the search fund. Okay, what are they looking for? Sometimes it's interesting because they're looking on not as higher level companies as private equity, so be interesting. So again, there's a little bit of niche in that market. So maybe, we're around the 5 million or something like that. You can see that a lot of them are looking for businesses which are in a positive situation in terms of finance. It's much harder to work with, for the moment, search funders on companies that may need some form of restructuring. So I think you've really got to be experienced in that area. And then you can see here, I've given you an idea, lower mid-market companies that really fit the criteria that the searchers are looking for. Obviously, again, it's important to have a deal flow pipeline. Some of them set up separate companies while they're doing their search, and so they advertise the fact. They're very present on social media. They try to attend all the possibilities, all the things that are organized regionally, nationally, sometimes internationally, where you can pick up deal sourcing. Some of them are able to get hold of interns, which obviously sort through a lot of information, a lot of the data and things, build up Excels. And of course, those with a little bit of extra cash can actually go into and probably get their hands on some sort of software which will help them to really source the right deal and really pre-screen. So that's important. Because some of the comments I've had from searchers is that, Carl, I spent 2 years, I looked at 100 deals, in the end, didn't get there, didn't go through. So they're also looking for advice about how to go the next steps further. And I think that's where we can also add value, because we're doing it already probably for potential buyers and helping to get those targets, up to speed and provide the right information and the key factors and all the criteria that a searcher could be looking for. Okay. So, again, be flexible on the services that you can provide. So buy-side support wherever possible. How far can we go? How far can we go to support them? Also need to, again, as I've mentioned in previous academies, the notion of explaining and making current business owners aware of the search fund model and how it can help them to find an appropriate buyer, somebody to carry on that legacy of the business, is really important. So again, that's where you can, also play a role and introduce the search fund and explain that, that's a way of finding a solution and, getting everybody involved in the deal. So the searcher, maybe the search fund investor, okay, and of course the current owner, to see how you can structure something a little bit like, we're probably all doing now, but obviously adding an extra element in there with the search fund, the potential business owner. But it's, it's like an individual acquirer who comes along at the moment with or without financing. Okay. So partner with the investors as well. So sometimes they're specific private equity, sometimes venture capital firms. We can find institutional, but it's still very rare. Family offices, it's also a model that's of interest to them. as long as everybody understands, where are we going in terms of capital raising and availability, and in terms of the risk. Okay, and of course, again, it's interesting. Maybe you've got a company where you don't find the right profile buyer. It could be a strategic buyer. Maybe the sellers are looking for really, that 1 in a million person that's going to have, the strategic fit, the cultural fit, carry on the legacy, and maybe somewhere in those search funders, if they've got the right access to capital, we can come up somewhere with a winner. Okay, so it's important that you spread the word about this system, workshops, whatever you can do, individual meetings, okay, and also offer, the mentorship, the support, building up as we move forward to the deal. I think that's really important. Okay, so I've given you lots of key things to think about there, and no doubt there will be questions afterwards. Here is just a few, summing up. So obviously Spain was one of the first countries, but I can also see in France, in Germany, UK, and I think Rose, you mentioned also that there's talk about it also in the Netherlands. People are not quite sure. So they're trying to work out what it's all about, and how you can fit into the ecosystem of all of that. And I think it does offer an alternative model for solving some of those succession issues, but also for very motivated candidates. And I would have a tendency to say that students, I can see after a couple of years experience, some of them would be capable of running a small business, but also the more senior searchers out there, those of them with a lot of experience that they could bring to a business and bring a strategic plan, and maybe they can see a little bit further than the current owner, and they can see opportunities also to build something around that current business, which could be of interest, and of course, as we all know, keeping the businesses alive in some regions in Europe, keeping the jobs, safeguarding all the know-how. I think that's really important, and any model for me that goes in that direction, it's a win-win for everybody. So I'm going to step back for a little bit now, and I'm going to pass over to Mikko. So I think, Mikko, you've got a couple of slides, and if you'd like to take over from there, then I'm happy to let you go.
Happy to do that. Thank you, Carl, for that comprehensive introduction to the model. And let's see if I have anything to add actually on top of that. And thank you also for inviting me and Paulo to provide some perspectives on this. And it seems like today there is a specific dress code for the testimonials, so uncoordinated, but here we are. Good. So let me just start by introducing myself. So my name is Mikko Järvinen, and I've been working for 5 years as a partner with True North Search. And I want to make it clear, True North Search, we are not a search fund, but we are an accelerator working with individuals who want to take this path forward. So how this actually works is that once a year, a couple of times a year, we have a recruitment that we run to identify individuals who would be a good fit for this career trajectory. We provide them with training, we provide them with additional support, including supporting the capital raise to move forward with the search journey. And another thing may be worth of mentioning, Carl, you had a great graph on the traditional funded search and then this variation of the model called self-funded search. So we are very much working with that self-funded approach. And what that means in practice is that there is no capital raise for the search stage. The searchers taking this path will be self-financing the search stage, and the capital raise happens only for the acquisition. So that's maybe a specific flavor of the model, that how we are working with this one. Why we are running this with that model? We believe that provides a bit more flexibility in terms of targets and also for the economics for the searchers. And it also might be a good match for the more experienced individuals taking this path, as you, Carl, presented. So just to give you a flavor also of the deals that we have been working with, I brought up 3 of the most recent ones. So Meluton, which was acquired by Jussi Niemelä, actually a bit over a year ago. Catering Content, Koen van Niersen, this is in the Netherlands, and Digitechno with Markus Henriksson. And basically all of these were owner-operated businesses before the acquisition. For Catering Content and Digitechno, the seller motivation was clearly the retirement. Actually, with Digitechno, there are 3 owners, and one of them has retired immediately, and the 2 are planning to do that in just a couple of years, but still continuing as employees or directors with the business, not owners. And with Meluton, also a bit typical, quite typical case. You have a 2nd generation owner operator who is maybe at the stage of the career where there is maybe a curiosity for a lifestyle change, maybe this kind of like, how would I say, idea somewhere in the back of your head that would there be something else for me than just continuing in my father's business. So that's a typical kind of motivations that we see. And yeah, what the companies are about, Meluton, that's basically noise insulation materials. I like the business. It has really wide range of industries that it's catering for, from sustainable energy production to defense to transportation to maritime. Catering Content, typically catering businesses might be a bit strange for this specific model, but in this case, there is also a high level of recurring revenue coming from serving meals to homes of elderly customers. And Digitechno, there some of the products and product line are very critical for the customer. So there is also kind of like, let's say, high retention on that side. Could you please, Carl, give me the 2nd slide on this one?
There we go.
So thank you so much. So I think in context of this discussion and this academy, I wanted to bring maybe a couple of points from our perspective, what we are seeing when we are specifically working with seller-side advisors. So I think there was a lot of good ideas and good proposals on how the collaboration with the search funds could work out. Our experience so far with the M&A advisors have been mostly as M&A advisors, as seller advisors. So brokering businesses and etc. And in these interactions, talking with business brokers, it's always important to understand what is the kind of like criteria that you're looking for. I think there's on that assessment criteria shopping list, there's probably stuff that everyone is interested in, but a few of those I wanted to go through maybe more specifically. And then also the points of difference for the sellers. So from the seller's perspective, thinking of these owner operators, owner managers, what are the kind of like interesting aspects that seem to resonate when interacting with search funds, or in our case, the self-funded searchers. So I'll start with the point of differences just briefly. I think one aspect definitely which resonates is the buyer with a face. Typically, the relationship becomes quite intense with the potential seller and the searcher, and they really want to kind of, on the best case, they're kind of like building a bond in very kind of like personal level. So it's kind of like a seller selecting the individual successor, the individual person who they are passing the company towards. And you can be quite certain of who will be actually running the company after the transaction has been made, which might not be that clear in the, let's say, traditional private equity world or in case of an industrial buyer. What our sellers have also been really keen on is the very short transition period. They might have alternative exit opportunities where a fund entity might be involved, and there you might be seeing very long earnouts, very long commitments spanning over years until they're actually getting rid of the business and being able to retire or having the lifestyle change that they're looking for. And then maybe the third item, which seems to be quite critical for many of the sellers, want to see the businesses continue as independent. And that is something that with this model we can promise. It's not going to be sold to a competitor. It's not going to be, let's say, relocated or something like that in the short term. So that has been something that is really attractive also for the sellers. On assessment criteria, maybe reasons why these items are important are that, as Carl explained, there is the leverage element here, and you want to be careful with that debt service. I think the amount of debt leverage might vary a bit from market to market. Search funds, especially in US, seem to be typically quite hesitant to go beyond 50% debt funding in the deals. Typically might be even lower. In the Europe, and especially in the Northern Europe where we are working, the availability of debt seems to be, let's say, better than the availability of equity. And in that case, we're also looking at maybe higher leverages where the, let's say, strong repeating cash flows are quite important. And maybe another perspective in addition to cash flows is the growth. So we're looking at the strong margins, strong cash flows, but necessarily not growth. Actually, turning that around, when you see kind of like historical growth opportunities where there is strong historical growth, typically we also see situations where there are multiple bidders, and it seems that industrial buyers might be able to price in synergies, or there might be buyers who are just willing to price in the future growth. And sometimes with these faster growing companies, we're not just going to be able to match the bid that some of the other buyers are giving. So maybe that's probably all on my side. I'm not sure if I've gone over my 5 minutes, but I guess key points what I wanted to bring this our perspectives on working with seller side advisors and what can be relevant for the sellers when they're interacting with the searchers, be them self-funded or funded, and also the couple of points from the assessment criteria, strong cash flows, and the relationship that we have also with the growth.
Okay, thank you very much, Mikko. Very interesting that input. Thank you. So now I'm going to go on to Paulo. So Paulo, if you're ready, it's over to you now.
Yes, I think I'm ready. Thank you very much, Carl, for the invitation and Transeo, and thanks for your testimony, Mikko, and also the clothing coordination keeps it standardized. So my name is Paulo Ribeirinho. I'm Portuguese. I'm an engineer. My career has been around operations consulting in shop floor factories in Portugal and Spain, and I then moved on into startups with Rocket Internet in Nigeria, building warehousing, customer service, distribution. Then I did my MBA at INSEAD, where I learned about this concept, but I was a bit too scared to chase it at that time. I took the safe route and went to work for big tech in London at Microsoft. And then more recently, came back to Portugal, invited by a big corporate that asked me to do a startup for them, a marketplace right before COVID in e-commerce, which went great. And then we got acquired by the big corporate 100%. And that wasn't for me. That meant, I wanted to continue my entrepreneurial path, and the search fund started making more sense. So I'm working with Novastone Capital Advisors. It's a bit of a different model from the one that True North and Mikko pursue. So Novastone Capital Advisors invests directly in my search capital. So they allocate a chunk of capital for my living expenses, my due diligence expenses, my intern, and they give me 2 years to find a company to buy. So I just finished my first year. I started in March last year. I'm currently under LOI and doing financial due diligence. My search actually had two pillars. One in manufacturing in the north of Portugal, where it's strongest, and the other in engineering services. So that's where I felt I could add the most value. Or understand the businesses, and I have the digitalization experience to bring the value add, or try to bring the value add. So the company I found is in engineering services. I found it through a broker, actually. And they work in construction inspection in Portugal and Brazil. So the Novastone model means the type of targets that I go after are a bit bigger. Yeah. So as Mikko was explaining, the financials of the model means that the deal has to pay for all these expenses with my search, the value allocated to the upfront due diligence costs and legal costs. So this is a bit bigger than the traditional search fund. It's a 6 million euro EBITDA, 30 million euro sales. So now, just so I don't go over my 5 minutes, I would just like to explain a bit how my search went and how I felt working with brokers. Of course, Mikko has a much broader overview, right? He sees a lot of searchers, and this is my experience with my market in Portugal. So in this year, I believe I spent 90% of my time on proprietary search. Yeah? So bear in mind that my company was found through a broker. Now, proprietary search means, I went through Orbis or whatever the Moody's platform is called in your country, got all the companies with the financial indicators that I want to go for in the sectors that I want to go for. Concatenated names in the board, sent them emails, sent them physical letters in a very nice paper addressed to the board, asking to speak to them and explaining who I was. I called them on asking to speak to the CEO, a true sales development representative, SDR work. Had a lot of no's. Actually had 100% no's. If you think about it. Made a lot of offers. Made 18. I sent out 18 LOIs during this year. All rejected. And I also did the same type of work with brokers. What do I think about proprietary search? It's a numbers game. So the clear indication of sale is not there, right? When a company comes to a broker, there's that this is much better than I'm just sharing what I learned. the indication of sale is there. They want to sell. Yeah. So they've gone through the work of talking to a broker and initiating that business. In the proprietary search, that indication is not there. So they haven't reached out to a broker. They hate private equities because they're calling them all the time. They accept to talk to me, many of them because I bring a different, my model is different. I'm going to be managing the company. I want to buy 100% of it and ask them to roll over a part. That's another story. So they engage with me. The brokers, what was my experience? So as imagine it's the case in your geography. So the quality of brokers, it widens, right? There's just curious people with connections with very little financial expertise, and bear, I'm an engineer, so so I'm not a finance expert, that do not understand the model at all, and they're just trying to make a living. And then there's the Deloitte's, Ernst & Young's, KPMG's, and those I felt they want to work with the private equities. All the deals that they brought to me were normally things that had already been rejected by God knows how many private equities, and didn't work with them, right? So still, I found that there's a lot of very, very professional brokers that I felt that they didn't understand immediately what I was looking for. They saw me as a competitor to private equity, which I am not. So, and I had this experience. It's impossible for me to compete in a competitive process, right? So the search fund has a discount, right? You're replacing the owner. He will leave, most likely, he wants to leave, and there's a risk associated with that. The returns expectation are higher, which means that there's a discount, another discount there. And then if the company doesn't meet that criteria that all the search fund has and that Mikko shared, that's another discount. So high working capital, high capex needs, very, very low synergy identification, right? It's not, you're not a strategic that will be able to absorb that company and buy its client roster and get it working like your group is. So getting that match with brokers was a bit difficult for me, because indeed it's a very specific case that I'm looking for. That said, I maybe I'm jumping the gun, but I was successful, and I met a broker that really understood what I was looking for, and he had this opportunity for me where the searcher, the CEO wants to leave, and there's a discount there, and we managed to build that relationship.
Okay, really interesting. Thank you very much, Paulo. Thank you. So,
thank you.
I'm just going to unshare my screen, and we'll come back face to face. I've got a few slides just afterwards, a few takeaways and things like that. But if anybody's got any questions for Mikko, for Paulo, or myself, I think we've got a few minutes, Laura, to maybe take a few questions. I haven't looked in the conversation, but maybe there's things
thank you,
there.
Carl. We had 3 questions. I leave maybe Laura.
Well, it doesn't open on my side. I don't know why. Okay, finally. So we have one question from Brit in the Q&R. Brit, maybe you want to ask your question live. It might be easier if it's okay.
We have actually experiences with search funds, and we sold a company to managers who were assisted or funded via search funds. And I'm really surprised that you're saying that they usually plan exits in 5 to 7 years. For my experience, the managers are more in a position to have a longer term view, and they will stay in the company for well, many years, more than only 5 to 7 years. So the question is it only the search fund who will exit after 5 to 7 years? And if so, is it possible that the managers are able to repay the search fund? And do you have perhaps statistics on how long companies are held by the managers?
I don't know, Mikko, do you want to give your, have you got maybe a quick answer on that one from your experience before I?
Yeah, I can try. so I'm actually trying to remember because there's Stanford and IESC have been tracking the model for quite a long time.
Yeah.
And I'm trying to remember, it might be that they don't actually track the, they track the holding period, but I'm not sure if they track the kind of like buyer or the secondary buyer or exit, who actually eventually buys the company. What we do with TrueNote Search is that basically there are, I mean, what happens after, let's say, a holding period of 5 to 7 years? Two things can happen. Either there is a third-party buyer, be it an industrial buyer typically, or something like that, who wants to acquire the company, or the manager or the new owner-operator, the searcher, who takes over the company, has the opportunity to actually, because basically through that 5 to 7 years, he or she is basically deleveraging the company, and then might have the opportunity to raise again debt funding and buy out those investors at some stage of that holding period, meaning that he or she ends up with owning 100% of the company after that transaction. So that is definitely in our model what we want to make possible and want to enable.
Yeah. As well from my side, Britt, I've seen a little bit of everything. So what's interesting is this hybrid nature, I think, of several possibilities. Searchers have come to me and say, Carl, I want to do this project. It's a little bit like, and I call them serial entrepreneurs or serial acquirers, is that after a period, and I don't mean, I'm not being detrimental to anybody here, after a period of managing the company, they would probably like to move on to something else. Could be in a different country, could be another industry sector, could be a way of moving up. And if they're able to sell on that business at a given time and everybody exits at a given moment, okay, that enables them to recuperate capital then for the next project and so on, and they start the whole process again. I had the opportunity of working with a son, a grandson of a well-known family in the north of France, who said to me, Carl, I want that. So he gave me the criteria. That's the deal size. That's how many people, no farther than 15 kilometers from my house. And I'm going to stay with this company as long as possible. So I think you've got a lot of broad perspective in there. And I think when you get into a company, it's only the tip of the iceberg. You only start to discover, unless you're from the industry, afterwards. So you might have a plan and say, oh, I'm going to leave with the guys who finance me. Or, well, I really like this, Carl. I'm going to carry on. So I'm going to, as Mikko said, I'm going to carry on there and try and find some system, MBI, MBO type transaction deal afterwards, or raise future capital so that I can carry on. So I think it's really, you know, it's more than cultural. It's more than anything else. It's how do I fit into that business? And if they fit in well and they've grown a little bit, I think in your slide, Mikko, there was something about no growth. But if they were able to move that company forward, then I think that could open opportunities, and then people would probably be more willing to stay on. I'm working on statistics, not only we're about at the moment from the United States, from Canada, from Spain, about investors who invest in the long term in search funders. And we want to go a little bit further. So maybe I'll also be able to produce something, academically speaking, which gives you an idea of, you know, who stays for how long and what sort of sectors. But at the moment, we're right at the beginning, Britt. Okay, so I hope that answers your question.
Yeah, thank you. Because one of the main arguments for a seller selling to a search fund or to a manager is that the company will keep independent not only for 5 or 7 years, but well, basically for decades.
Yes.
And this is what difference a manager from just normal private equity companies. So yes, the statistic would be very
I've always
Thanks. Thank you.
Yeah. I've come across one deal where the searcher did stay on, and he actually bought out the investors, so he bought it back, but with the employees. Okay, so again, that's a way of making sure, and he was even thinking about converting it into a foundation, which would be impossible then for private equity or somebody else to come along and snap it up. So the reflection is there, but obviously you've got to be clear on where you want to go yourself and where you want to take whatever business I would be prepared to say. Okay.
Right. Thank you.
Questions?
Martijn has a question,
Martijn?
I think.
Yeah, I was wondering, and maybe it's also a little bit for the last question, but does the search fund provide all the capital when they find the company and also for the search, or do they do a percentage, and has the searcher also has to arrange some own funding?
Paulo, maybe you can speak about a little bit about that.
Absolutely. Yeah, so in the model where I'm at, Novastone contributes about 90% of the search capital, and I contribute roughly 10%. Yeah? So my search capital, because it also depends on geography, is something like 600 and something thousand euros. I think that's the usual amount that covers living expenses, due diligence expenses, legal expenses, access to platforms and such. Yeah, and I think that is the case with most traditional, not self-funded search funds.
And what's the roughly the share division then? Is it also 90-10%, or is it different, or?
Yeah, so this usually the way it works is the search capital is then incorporated into the deal with some sort of a step up to incentivize the investors that came in early, sort of like an option, imagine. And then it depends a lot, right? Because this is something like a deal club, right? When you have a deal, you're going to have to fundraise. You're going to have to find investors, and these might not be the original investors in your cap table, right? So that division is it really depends on the deal. What I can say is that usually the search fund model doesn't like majority shareholders like in private equity. So you have a board that is a bit more independent, and you don't have a single voice that can direct the vision for the company. Yeah.
Is that okay, Martijn? Yeah.
Okay. Yeah. Thanks. Yes.
Okay. So I think Lexis, can I take that question, Laura?
Yes, of course. Go ahead, Lex.
Yeah, thank you for the very interesting presentation. We have programs where we support especially students to become the new owners of the family firm. And I was a little bit surprised that the criteria is that there is low capex necessary, because generally, if you want to stay ahead in your industry, you have to massively innovate all the time. That's first, and second, low key man risk is hardly possible in small firms, because it's defined by small firms is less than 50 employees, and then you have the owner shareholder having a major role in the company, deciding on anything. So if the small owner falls apart or is sick or falls away, the company goes down generally. So I was a little bit surprised about these criteria. This is mid-sized firm criteria, not small firm criteria, in my opinion. So can you tell a little bit about that? Because capex is always necessary. If you want to stay ahead in your market, you have to invest heavily. Also in services.
Mikko, would you like to?
Yep, happy to do that. I didn't put any figures on either low capex or low key man risk. So I'm gonna leave it kind of like open what it means in euro terms or percentage terms. But I agree with the points. There are industries and businesses where capex is required, that needs to be there, and of course with small businesses there is always key man risk involved. Maybe it's why I want to bring those in the criteria and also remind our searchers of that is that well, starting with the capex, I'm sitting in Helsinki, and we have a lot of let's say industrial contract manufacturing in this country, typically serving domestic or German industries here. And we see a lot of companies which basically show great profitability, look really nice margins. But when you dig deeper, you kind of like understand the business model is basically based on investing everything that the company is generating back to the capex in order to keep up with the competition and keep up with the customer requirements. On top of that, you might have actually requirements on inventories and such, which essentially means that all the cash you're generating is going to the capex and working capital, and that is basically a quite difficult proposition for us if we want to use leverage for the acquisition. So that is basically the perspective why I wanted to bring the capex. So just being mindful that you can still do the leverage buyout after the capex. And also maybe the low key man risk. With this model, there is the succession. The current owner operator either retires or does something else in his life. So that is a transition that needs to be managed. But on top of that, you might have, let's say, specialist roles which are really difficult to backfill on some of the industries. We're thinking of maybe some scientific or high-tech type of industries where you just are not going to be able to get replacement workforce for certain roles. So that is something that we want to have our searchers to be conscious also of.
Okay.
Okay.
So it's more a point of attention, and it's not, you don't have say if you use more than 10 or 20% of your EBITDA for capex, there's no deal.
Yeah, I mean then you will just look at what the cash flow the firm is after that capex, and is there any kind of like let's say room to maneuver.
Yeah, and return on investment, of course.
Yep.
Yeah. Okay. Thank you.
Okay. Thank you very much. Thank you, Mikko. So I'm going to reshare my screen just to conclude now. So there we are back, hopefully. That's the case, maybe. But I went and reshare it again. Sorry about this. There we are. So just a few takeaways for you to consider based on the testimonies from Mikko and from Paulo and from myself. And I think some of you have already as well investigated this model, so we can come a little bit, I suppose, to the same conclusions. But it is something obviously that we can go on and grow and hope to develop. And of course, as Lex just said as well, I'm working as well with students for them to think about, particularly in family firms and smaller firms. Okay, not already aiming for those 50 million EV valuations and so on. So I think it does represent opportunities along the line for all of us in terms of awareness of the model, providing opportunities for the advisors, but also finding a solution for succession of some of those family firms and entrepreneur-owned firms throughout Europe and further afield. Of course, Laura will make sure you'll get a copy of this PowerPoint afterwards. So a couple of links there you can see already from Stanford, so where it all started, how they brought about the model. And then I think IESE in Spain is really the European university that we should be looking for. And then a couple of sites where you can actually pick up a lot of information, searchfund.org and searchfunder.com. Okay, and there you've got my contact details at the end. So if we weren't able to answer all of the questions, or maybe ideas and things you have, so please feel free to reach out to me, and I will get back to you with answers and things. And as I said, I'm trying to move forward as well on the academic, on the research side of building up databases of all this. So obviously I'll be able to share that, but a little bit later on, let's say. Okay, thank you very much. I'm done, and we're not too much over time, so 2 minutes over. Okay,
that's perfect. Thank you so much.
Thank you, Carl, Paulo, and Mikko, and thank you for attending and asking your questions. If you have other questions that you would like to ask to our speakers, don't hesitate to reach out to them directly or to go through the Transeo team. Really, it's up to you. Thanks again for attending. As a reminder, we will have our summer summit on the 19th and 20th of June in Padova, and the next Transeo Academy will be on June 3rd. It will be about cross-border deals, and it will be given by Monique, Denis, and Bas. So we hope to see you at the Transeo Academy and/or at the summit. Thanks again for attending the Academy. The follow-up email will be sent this afternoon or tomorrow in the morning. Thanks again. Have a nice lunch. Have a nice day, and see you soon.
Thanks.
Thank you. Bye-bye.
Have a nice afternoon. Bye.
Thank you. Bye.
Thank you.
Thank you.
Bye.